next guest says investors just need to relax. Lee Munson of Portfolio Wealth Advisors joins me now to discuss. Lee, I can't believe it when I was reading the notes for this interview. You relax?
I've been known to do it, you know. It's like, you know, we're out here in the 505. We like to chill out.
The 505.
We're in New Mexico.
That's right, New Mexico. All right, so here we are. We're getting into summer. May is here, historically. Not the best month for the markets. Not a great day today. What are you doing right now?
Well, I'm mostly planning a trip to LA to go see Turbo Negro, some Alaska cruises, some trip. See, here's the thing. Okay. I already did my buying, and I'm a little bit smug about that, but I already did my buying in February, that first week of February. So I got the prices that I want. However, there's some people who've sent me more cash, because that happens, and new clients. And so I'm going to spend between now and August, so I'm sort of saying it, between now and August, I think the market's going to churn these levels between where we were in early February, but not really to the new highs. And that's a thing that some people could misconstrue my comments as not being bullish. I'm bullish. I think we hit January 22nd highs before December 31st this year. But I think summertime, it's going to be slow. We've had all the news. Earnings was fine, but it wasn't really dynamite. And so I think people should stop thinking that there's going to be this new high around the corner and start strategizing and saying, if I didn't get enough money in there, am I going to have another shot at seeing 2,600 on the S&P? Probably.
So earnings weren't dynamite, but they were fine. Shouldn't that give us some momentum into the summer?
No, you'd think on Wall Street, people like good news, but everybody's so impatient, they want to poo-poo it. And I'll tell you why. There's this concept that the employment numbers were very good. And I don't see them as very good. Participation is actually down. Labor participation is actually lower year over year. So you got some economic factors that are a little bit of a headwind because they're not great. But when you look at the aggregate earnings, we're still talking about double-digit increases. But again, Wall Street thinks the market is priced for perfection. And there's this belief out there that we have to have super amazing earnings or something special needs to happen. Like, you know, Apple, we weren't sure Apple was going to hit their earnings because they didn't come out with, like, you know, a teleporter with the new iPhone or something like that. All it has to do is
We're waiting for that. I'm waiting for it. So in the summer, you know, sometimes stuff happens in August, sometimes when you're not looking, and I know you're planning all these trips and you're telling me just to relax, but could we, given what we're seeing with consumer data, we've got the Fed coming up, could the market tumble this summer? Do we need to prepare it at all for that case?
You know, yeah, I'm prepared, right? I'm prepared with a bunch of stockpile of bond positions I'd love to sell if it goes down lower. So I'll tell you my levels, and I got my whiteboard here. Of course, there's some sheet over it from some trip I planned.
Who put that sheet there?
But my inside price here on mine is 2480 is my actual number, but we know black boxes, you know, algorithmic traders are going to screw that number up. So I'm looking at something that says 2,500 on the S&P. But I'll tell you right now, if we see 2,520, you know I'm going to be buying, right? Because I'm not so sure we're going to get that low. Because again, fundamentally, there isn't a problem. We just don't have anything that's over the top phenomenal. And here's the other thing. The tax cuts are going to take time. And I believe Wall Street is impatient. You just read, you know, there's an article today in the Wall Street Journal about CapEx expenditures as if it wasn't good enough. Or, you know, I mean,
or that they're just afraid that they're spending too much of their money on it.
Well, I mean, my God.
Do we want companies spending? I mean, what the CapEx is up, the best start to a year in quite a few years, I think it's up like 20%. Is that what we want?
Of course it's what we want. We want them spending cash to invest. And that's not good enough? I mean, come on. Factories aren't prefab things you order from China and they just plop them on. It takes board of directors to figure out, what do we want to do? Can management get this done? You can't build Rome in a day. We just got the tax cuts a few months ago, and I think investors think that all of this money should magically be spent overnight or just given back to us in stock buybacks, which will actually reduce shareholder values. So I think the CapEx numbers, they're great, and I expect them to continue to improve, but we've got to get the tax breaks first. And by the way, who's in a hurry when we have double-digit year-over-year earnings growth? So I'm really having a hard time wondering how we're going to get to my little inside number of 2,500 on the S&P, short of panic, Bitcoin crisis, North Korea was actually lying, Iran blows up, Trump does something right, Trump does something wrong. So it's really going to take a village, Jen, to get this market to go lower. And if it does, buy it aggressively.
Could the Fed be part of that village? And don't make a
yes.
joke about the village idiot or anything, but Fed funds futures pricing in 4 rate hikes this year now, greater than 50% odds, just baked in.
What is making these odds? It's a bunch of punters and
It's the
speculators.
market.
I mean, this is the 50%. Here's the problem. You get something, odds, and then people go on TV like today and say, the Fed's going to raise rate 4 times. I don't see the Fed's raising rates 4 times. I just don't see it. Why? Because we don't have any wage inflation. The unemployment number, I love that it's nominally below 4%, but labor participation hasn't moved since 2013, right? And productivity continues to go higher. And between the Fed raising rates 4 times, fat chance, I'll say I was wrong in December if that happens. And then between every Tom, Dick, and Harry on TV saying, we can't squeeze any more productivity out of workers, man, they've been saying that in my entire 20-year career. That's like betting against the U.S. consumer. I don't buy it, and I think people got to get out of this mentality.
Hey, Lee, if you had to buy something, they send you the money and you have to buy something, what do you like right now?
Oh, it seems like such a blowhard. I'm actually adding to some of my REIT positions right now, just because they're super beaten up. I know that seems so boring and dull. I'm adding every place across the board in small cap value. If you want to buy tech, go buy tech. I like to get broad-based index funds. And I think the action is not the S&P. I think the action is still, you've got some heat in emerging markets. They've come in a little bit. But really, small cap value is the place to go. Why? Because fundamentally, earnings are good there. The small caps are breaking out. I mean, you can see that in almost every chart that you'll look at. The other thing is tax cuts in this country are going to help these small companies because they don't have the advantage like an Apple to skirt federal income tax. So if you really want to bet on higher productivity and not wage inflation and also a rush to this country from international companies wanting to invest in America, your smaller companies, no matter where they are, just by all the small cap companies out there, I think 2 or 3 years from now, you'll be very much rewarded. And tactically, that's where I want to put my money where my mouth is.
Lee Munson, Portfolio Wealth Advisors. Always great to talk with you. Next time we want to see the whiteboard. So we'll get back and see how relaxed you are as we head into summer.
Yeah, that's like the
Glenn
month. Gary leads, only for.
Oh, really? Okay. Well, you'll give us some behind the scenes something next time. Great talking, Lee.
See ya.